Hi, I'm James Dunn. Welcome to the Inside Network. Joining the Inside Network today to discuss the opportunities and risks present across the Australian equities landscape. It's a great pleasure to welcome Dion Hershan, Executive Chairman, Yarra Capital Management. Welcome, Dion.
Thank you, James.
It's a great pleasure to have you here. Dion, how is the market viewing the structural environment? Because there appears to be simultaneously concerns around economic growth, but also a belief that many companies can continue to grow their earnings pretty significantly.
It's a good observation. There's a real disconnect between what's happening in the economy and what consensus expectations are for a recovery in earnings for the ASX 200 or 300, depending how you look at it. Let's focus for a moment on the economy. The economy's growth is, at best, you'd call it anemic. It's 1.5% GDP growth, unemployment's trending up, debt levels are high, and many of the factors that really drove Australia's economic recovery post-COVID have actually gone into reverse. I'm referring to the level of immigration, I'm referring to what's happening with commodity prices, and equally what's been happening with the offshore student market as well, all of which now represent headwinds rather than tailwinds. So that's the backdrop, yet there's this view that next year will be a stronger year for earnings growth. And the context is important. Fiscal 23 and fiscal 24, earnings went backwards for the Australian market, yet there's this sort of somewhat naive expectation that 25 will be a recovery year and a much stronger environment. It's possible for a company, it's possible for a sector. We believe it's highly unlikely for the entire market.
Many advised clients have done very well from over the years and become very used to dividend flows and capital growth from some of Australia's legacy blue chip stocks, being the four major banks and the three big bulk miners, for example. Is there a level of complacency, and should there be concern among investors as to the future success of that kind of strategy?
Yeah, we think there's grounds for concern, and I don't want to sound alarmist, but I'll make a few obvious observations. Banks are about 23% of the Australian market. The sector's earnings peaked in 2017. There are quite formidable headwinds associated with margin pressure, cost growth, bad debts normalising off really depressed levels. Yet the stocks have been unbelievably strong. And we're now at a period of time where valuations for banks are elevated, dividend yields on average are under 4.5%. And we don't think they can be the powerhouse that's driven up markets in the future in the way that they have in the past. In contrast, the bulk mining sector, as you described it, it's a deep cyclical industry. And if you look at the likes of BHP, Rio and Fortescue, they have very little volume growth. So most of the profits rely really heavily on commodity prices. And the commodity price basket they sell is really heavily skewed towards iron ore. I think it's becoming increasingly obvious that iron ore is oversupplied. The high prices we've seen historically are unlikely to be repeated. And if profits come down, so too do dividends, which is why we encourage clients to look beyond those sort of 7 biggest companies as they seek opportunities.
So given that our index is dominated by these business models that as you point out, lack an obvious catalyst for growth, and that the solution to that is to sift through opportunities and cast your net a bit more widely within the equities market, would you counsel investors to have specific style or sectoral biases as they start to look more broadly?
Yeah, look, we don't have a strong view on style. Like, we're not here to say the best opportunities are value or growth. In fact, how we invest is pretty much across the spectrum. We just look for great opportunities. As it turns out, we think the better opportunities exist outside the 20 biggest companies. In fact, we probably think the sweet spot of the market today is probably mid-caps. If you look outside the 20 biggest companies, you've still got an addressable universe of about $1 trillion to invest in. It's liquid, it's less well researched, there's great variety by sector, by stock, and really very much by theme. So we think that's frankly fertile territory for stock picking.
What capitalisation parameters would you say that opportunity set cuts out at in terms of a lower bound?
Yeah, in terms of a lower bound, I mean, we find interesting companies as far down as $500 million of market cap. The upper bound, when you're looking outside the 20 biggest companies, you've still got companies that might have 10, 15, $20 billion of market cap, but they're not the mega caps like BHP or CBA.
Going back to that, you said Woodside, for example, but then Worley Parsons, which is a services provider. So is it still valid to think in terms of selling the shovels to the gold miners, buying into the businesses that are a derivative away from actually producing the commodity, and businesses that serve those producers?
Yeah, we think that's a really robust theme over time. I mean, pick a number. People have speculated on how many trillions of dollars need to be spent on decarbonisation. The only certainty is you will need engineers, you will need construction, project managers, and Worley Parsons is literally the picks and shovels as you described, and we think there's a great opportunity there.
Software as a service companies proliferate on the Australian exchange. We've had some really good ones. Do you think that's a sector that's worth looking at, or are some of them still on the route to profitability?
Yeah, so I'd say by comparison to markets globally, we've got very few software companies that are listed. In fact, the tech sector is probably less than 4% of the ASX 200. There are some great businesses in there. I mean, software as a service is now the default. You know, people are not selling licensing software the way that they used to sell it. But it's obviously got some really attractive attributes in that it's recurring, tends to be embedded within companies, businesses, or consumers' wallets for that matter. And if they've got strong value in use, it lends to really strong pricing power and low levels of churn. So, you know, as far as a theme goes, really attractive businesses, but you still need to match that with what's the underlying company, what's the valuation, and what's the opportunity. But we've been long-standing shareholders in companies like Xero that have got those attributes you described.
Dion, your team and yourself are known for wearing out the shoe leather visiting companies. Do you still find within your opportunity set plain old no-frills, profitable industrials that are really worth investing in?
Absolutely. I mean, there's no doubt about it. We've got a large team and a team that's worked together for well over a decade. I think we track at over 2,500 company meetings a year. We are still amazed by how inefficient parts of the market are, in particular mid-caps and small caps, and how much you can learn from seeing businesses, understanding supply chains, connecting with industry contacts. That's probably one of the most exciting and frankly rewarding parts of the job.
It's really interesting, Dion, with your X20 strategy that the moment you start to look away from the top 20 stocks, your sectoral weightings change and you effectively get access to a whole new share market.
Absolutely. In fact, it's probably a better read on the broader economy than the ASX 200. I mean, recognising banks are 23% of the ASX 200, they're certainly not 23% of the economy. Same to be said for the iron ore miners. So what you do when you look beyond the 20 is you get a broader representation of companies, you get a more fragmented benchmark, you get a less efficient group of businesses to research and invest in, and which gets to, I guess, one of our prior points, which is we think it is probably the sweet spot in the Australian market.
And less efficiently priced, one would hope.
Absolutely.
Australia, for example, has an ageing population, and it also has world-class medical research and some great healthcare businesses in the global context. So is that an area where you see compelling opportunities?
Yeah, look, we're reluctant to buy into healthcare as a theme. A lot of people get enamoured with demographics and look at how much money has to be spent and the size of the opportunity. But with healthcare, what we found is you need to be very sector and very company specific, and the micro can often be a lot more powerful than the macro or the demographics as you described. By way of example, if you only go look at the healthcare services space in Australia, where in theory the demographics are favourable, in practice a lot of those companies are dealing with labour costs that are out of control, poor productivity, capped pricing and margins getting crunched. And so our view is, you know, within healthcare you need to be very, very specific. We own companies like ResMed, we own companies like Ansell, which does healthcare equipment but also industrial equipment, and we're pretty selective about where we choose to invest. And at this point in time, we're significantly underweight a lot of those healthcare services companies you described.
You talked about iron ore, and certainly there is an argument that we've gone past peak iron ore in terms of the prices it can achieve and supply. Guinea's going to come on stream eventually. So the Australian resources sector, though, still, if we look at themes like decarbonisation and renewable energy, there's a huge demand for metals other than iron. So where do you see really good opportunities within the materials sector for Australian companies?
Yeah, sure. So our view is, look, decarbonisation is going to be an enduring theme that will unfold over decades. It's not immediate, and often it does get overhyped, and you've only got to look at the lithium sector and the froth and excitement from 2 years ago versus where we are today, and that's very much a cautionary tale. If you think about decarbonisation, in the medium term, we think one of the biggest beneficiaries is actually gas. To pivot away from coal, you need probably a lot more gas than you're currently using now. To transport the gas, you really need LNG. So we think LNG and gas is probably the sweet spot of decarbonisation investing over the next 5 to 10 years. For us, we express that view via owning the likes of Woodside, Worley Parsons, which is construction and engineering work, and also APA, which is gas pipelines. Looking beyond that time frame, it's reasonably obvious to us at least, copper will be a beneficiary, aluminium will be a beneficiary, and so too will scrap metals. There'll still be extraordinary demand for steel, but rather than just making it out of iron ore and burning coal to create steel, we think scrap metal will gain more prominence.
Dion Hershan, Yarra Capital Management, thank you very much for the in-depth interview.
Great. Thank you, James.
A pleasure.